Hello and welcome. This is Paul Pappas from Mortgage Choice. Today we're going to talk about the different loan types that are available to you in terms of, are you looking for a principal and interest reducing loan, or a P&I loan as they're more commonly referred to as, an interest only loan, or even a line of credit? What are the differences? Let's have a look. A P&I loan is in many ways a standard home loan arrangement. In other words, this is probably the type of loan that you would look to put in place if you're looking to place a mortgage over your principal place of residence. So it's a loan repayment, monthly repayment, I should say, includes interest plus principal, with the idea being that you are repaying the loan in full over the full loan term of 30 years. As the loan repayment includes interest plus principal, the monthly repayment is a little bit higher. But having said that, the interest rates are lower. Alternatively, if you're looking at an interest-only loan, as the name implies, the monthly repayment is interest only. Therefore, you are not making any principal repayment. It is designed to maximize cash flow and minimize your loan repayment. So depending on your circumstances as to whether that appeals to you or not, or suits your situation. As you are only paying interest and not repaying principal, the monthly repayment is lower, which then means that your interest payment can be a little bit higher. It could be more, and it is more suited to investors. So let's look at this graphically to try and illustrate this a little bit more clearer to us. If we look here at a standard home loan, call it $500,000. This is a principal and interest reducing loan at 2.5%, with monthly repayments being $1,976. So we can see here from the graph, you're starting out at a loan balance of $500,000, and over a loan term of 30 years, you are fully repaying this loan. So, but it's not a straight line, because during the initial years, your repayment has more interest than principal, and the principal repayments are accelerated in the latter years. If we look next at interest-only loans, so same loan amount, same interest rate, same everything, but this time around, your loan repayment is only about $1,000 a month. So in other words, the difference of $900 a month is what really goes towards principal or thereabouts. So graphically, you're starting out at $500,000 and you still owe $500,000 at the end of the day. So you're not making any principal repayments. I hope that sort of graphically illustrates the difference between the two for you. If you're looking at a line of credit is it's a Rolls-Royce type product. It's like a big credit card whereby you're paying interest on a monthly basis, but you're only paying interest on the amount utilized. So it's like a revolving facility whereby you draw down monies as and when required. If and when you draw down monies, you're paying interest accordingly on a monthly basis, and then you're repaying it back, and then drawing it back as required on a revolving basis. So it is, like I said before, a big credit card facility. It is designed to maximize cash flow and minimize your loan repayment, and you're only obviously being charged interest on the amounts that you use when you use them on a daily basis. It is a very, very flexible product, therefore the interest rates can be a little bit higher. It's an evergreen facility, as I mentioned earlier. Usually there's no expiry date, and the loan term is also, the interest-only period is also evergreen as well. So a very highly flexible product, but you do pay for it in terms of rates and fees. So which one's best for you? Well, it depends on your individual circumstance, and that's what we're here for, to give you some professional advice on. Please do not hesitate to talk to us in terms of which loan type most suits you in terms of your requirements. Thank you.